Okay, so last time I told you that the cost of debt at the firm, we use the yield to maturity. And I told you right before we left that I was going to show you how to figure out what is the cost of debt at a company that has more than one bond issue. If they have only one bond issue, it's really easy. It's just the yield to maturity on that particular bond issue. But most companies have more than one issue of bonds. So here we've got a company and there are three bond issues, A, B, and C. And they have different yield to maturity. Now, it's all the same company, it's all the same default risk, but as we discussed when we went through bonds, differences in the covenants can make some of these bonds safer or riskier. So for instance, this might be a convertible bond and it wouldn't have to pay as much. So things like that will change these yield to maturity versus one another for the same company. Then we've got the number of bonds in the issue. Now, this is obviously a silly example because you're going to have more than 10 bonds in an issue, but the math is exactly the same. Okay, so we've got 100 of these bonds, we've got 1,000 of these bonds, and we've got 10 of these bonds. That's my refrigerator letting you know it's defrosting. Okay, so, and then we've got the prices of these bonds. This is what you would pay for them if you went out in the market today. And all of the weights that we talk about, whether it's the portfolio weights for stocks, whether it's the weight for the beta of the assets and all that, everything we use are the market values, not the book values. We always use the market values. And we're going to see today that we use those for the weighted average cost of capital too. And so we're interested in what they're currently selling at. What's the face value of all these bonds, by the way? Yeah, it's 1,000, right? Okay, so what I'm going to do is I'm going to go through and I'm going to figure a market value for each one of these, how much of that money is outstanding there. And all we're going to do is take this number of bonds times the price of each bond. So this one's 100,000. Okay, here we've got 990 times 1,000. So I think so then this last one is 10 times 101, so we're going to have 100. Okay, so how do I figure out the total amount of debt that this company has? All I've got to do is add these things together. So this plus this gives us what, $1,100,000. So this plus 100,000. I think what we're looking at here is 1,100,000.
100.
Yeah, is that it? Mm-hmm. Okay. Now, here's how you figure out the weight for each one of these. X. So these are the weights. So this is X, A, B, and C. All I'm going to do is take the 100,000. And divide by that total. Then I'm going to take the 990,000 and divide by that total. I'm not right. Yeah, I'm right. And then the last one here, 10,100, divide by 1. Okay, so I can do that math out and get each of those weights. And then to figure out the overall cost of debt at the company, it's going to be my weighted yield to maturity. I'm going to take the weight of A and I'm going to multiply times the yield to maturity of A plus the weight of B times the yield to maturity of B plus the weight on C times the yield to maturity on C. It's that easy. So this looks a whole lot like what we did with beta. It looks a whole lot like what we did for expected returns in a stock portfolio, and it's because it's a weighted average. It's exactly the same idea. Questions? Okay, there's one more thought on this slide that I didn't talk about last time, and that is that we have to keep in mind that debt is tax deductible. In fact, it's the interest that's tax deductible. And so the true cost to the company isn't that yield to maturity. It's going to be the yield to maturity, and then we have to take account of the tax shield that it provides. And so we're going to say that the yield to maturity is the before tax cost of debt. The yield to maturity is the before tax cost of debt. And so what we're looking for is the after tax cost of debt. And that's going to be equal to the yield to maturity times 1 minus the corporate tax rate. It's going to be equal to the yield to maturity times 1 minus the corporate tax rate. And here's why. If I pay $1 worth of interest, I can write that off my taxes. If my tax rate is 30%, then I get 30 cents off of my taxes for having paid that $1 of interest. So that $1 of interest really only cost me 70 cents because it saved me 30 cents in taxes. And that's what this formula is all about. We're multiplying by 1 minus that corporate tax rate. In my example, 30%. This would be 0.7 times the yield to maturity. And if you're in a situation where your interest on your mortgage is tax deductible, in other words, you've got enough charitable contributions or whatever to cover your standard deduction, you can think of yours similarly with your interest rate on your mortgage. My interest rate is 3.375%, but my mortgage interest is deductible, so I can take that and multiply it by 1 minus my marginal tax rate. And I forget what my marginal tax rate is, but long story short, I'm not really paying 3.375% for that money because I'm saving money on my taxes as a result of having that mortgage. Does that make sense? Okay, we said that debt has a tax advantage over equity because of the tax shield. That's exactly what's going on here. This is the tax shield of debt. Okay, any questions? Okay, so now what we want to do is look at the overall company. We're going to try to figure out the company's overall cost of capital. And we said there's two ways that the firm can fund itself. One is with equity, the other is with debt. We talked about we can get the required return on the equity through the security market line. What was the other one? Yeah, dividend growth model.
Oh, yeah.
Yeah, dividend growth model. And then, and we're going to have one or the other of those. And then we've got our yield to maturity on our debt. And how much each of those contribute to the cost of capital has to do with how much of each of those things we have in the capital structure. And so if your capital structure is almost entirely equity, the yield to maturity on the debt will matter very little. But if you've got a lot of debt in your capital structure, then that's going to matter more. And so we come up with this weighted average cost of capital, which we'll refer to as WACC, W-A-C-C, WACC. And so what we're going to do is we are going to use the proportion of the capital structure, which is equity, multiplied by the required return on equity. Do you recognize these weights from last time? Yeah, that first one is just equity divided by the total value of the firm, and that is going to give us the proportion of the capital structure that is equity. The second one is debt divided by the total assets of the firm, which is going to give us the proportion of the capital structure that is debt. Now, keep in mind, these are market value numbers. Market value numbers. It's really easy to find book value. We're doing market value. By the way, how would I find the market value of the equity at the firm? Any ideas?
Isn't that the market cap? Like,
Exactly, it's the market capitalization, and how do we calculate that?
it's like all issued shares times the price of them.
Yeah, so we're looking at all of the outstanding shares multiplied by the price of the shares. And so that's how we're going to find that E. So that's just the number of shares times the price of the shares. That's what E is. And D, by the way, in our example here, that would be D, right? It's the total market value of the outstanding debt. And so that's where these weights come from. Don't get them off the balance sheet. Okay. So this is a formula that we're going to use to find the overall cost of capital for the firm. Do you think this formula should be on your note sheet?
Yes.
Absolutely. Now let's talk about down here on the end of this debt thing, we've got 1 minus T sub C. And it all comes back to this. When we're doing the cost of capital for the firm, we are only considering the after-tax cost of debt. Now, this is going to be a situation where you need to be able to do some reading, because if they give you the before-tax cost of debt, then you're going to multiply by 1 minus T sub C. But if they give you the after-tax cost of debt, then you don't multiply that, bless you. You don't multiply that number by 1 minus T sub C, because after all, the taxes have already been taken care of. Does that make sense? So you have to, once again, in finance, you have to read. This is just like determining whether we've got market risk premium or expected return on the market. Here you have to determine whether you've got before tax cost of debt or after tax cost of debt. And if you can't tell by reading, always assume it is the before tax cost of debt. If you can't tell by reading, always assume it's the before tax cost of debt. If it's the after tax cost of debt, the problem will make it really, really clear. Okay, so what should we assume if we don't know otherwise? Which one? Yeah, before tax cost of debt. Okay. So here is our WACC example. Your firm is financed with 2/3 debt and 1/3 equity. I'm not making you figure the weights here, but we could easily see that debt of 2, equity of 1, add those together gives us 3. And so it's 2/3 for debt and 1/3 for equity. They tell us the required return on equity is 15% and the required return on debt is 12%. Why is the required return on debt lower than the required return on equity? What and return always have to go together? Risk. So, which is riskier, equity or debt? Do you remember the line of people getting paid off at bankruptcy? Who's at the very back of the line?
Equity.
Equity is. Equity is the riskiest position, therefore it has to have the highest return among the investors in the firm. Debt holders get paid before they do. They've got a fixed claim, and so it's less risky to hold debt. Therefore, the cost of debt should be lower than the cost of equity. Okay, so return on equity is 15%, return on debt is 12%, our corporate tax rate is 25%. So, all we have to do is plug into that formula that we just had, and it's going to be 1/3 times the return on equity. What is 1/3 of 15? 5, very good. 5%, or 5%, yeah, that's correct. So that's the first part. Now the second part, I'm gonna start with the parentheses. The parentheses are 1 minus 0.25, that is 0.75, or 3/4. What's 3/4 of 12? 3/4, so what's 2/3 of 12?
2/3 is 8.
Yeah, okay, so what's 3/4 of 12? 9, right? So we're gonna take 9 times 2/3. What's 1/3 of 12? Oh, 1/3 of 9.
3.
3. What's 3 times 2?
6.
6. You guys can do this. You can do math in your head. Okay, so now we've got 5% plus 6%. We're gonna add them together for 11%. Now, one thing you can do to kind of halfway check your work, make sure that the weighted average cost of capital that you've calculated is between the two. right? It's a weighted average. It should be somewhere between those two. If it's not, you've messed something up, try again. Okay, so there's our WAC example, and you guys are going to get plenty of exercises that have WAC. Now, here's the bad thing. This is, by the way, very simple. I could have asked you to figure out what's the total market value of the debt, D, like right here. I could have asked you to figure out the total market value of the equity, number of shares times price per share. And then I could have asked you to figure out the total value of the firm, which is just add those two numbers together. And then I could have asked you to figure the weights for each one of these things, right? Because you got all those numbers. I could have asked you to figure out the required return on equity, and you'd do that with the security market line or the dividend growth model. And I could have asked you to figure out the required return on the debt. I could have given you some specifics about a bond, and you would have had to use those specifics to calculate the yield to maturity in order to be able to figure out your R sub D. Could this end up being a very, very long problem? Yeah. When you see something like this on an exam, look at it and see if I've given you a bunch of the components, go ahead and solve it. If I'm going to make you pick and blowtorch out all these different numbers from a bunch of different garbage, what should you do? Skip it. Does that make sense? Okay, now let's talk about more or less risky projects. Remember, the weighted average capital cost of the firm has to do with the riskiness of the firm's underlying assets. Last time we talked about that being business cyclicality magnified by the operating leverage. That's what this weighted average cost of capital is based on, is the risk of those underlying assets. And if we were to do a project that was equally risky as everything else the company does, it would be perfectly fine to use the weighted average cost of capital as our discount rate. Let me say that again. If we do something that is exactly as risky as the overall firm, it's perfectly fine to do the weighted average cost of capital. However, most of the projects at a firm, or at least some, are going to be either riskier or safer than what's going on at the firm. Most of these projects are going to be riskier or safer, and the discount rate of the project that we're going to do net present value analysis on needs to be determined by the riskiness of the project, not by the riskiness of the company. Let me say that again. The required return on a project needs to be based on the riskiness of the project, not of the overall company. Okay, so there are a couple of ways for us to approach this, because what we have to do is find something that is equally risky to this project that we're taking on. The first way is to find a pure play firm in the field of this new project and use that firm's weighted average cost of capital as our rate. Now let's talk about, let's use an example here. Are you guys familiar with the car company Nissan? Yeah. Nissan makes this, and I owned one time, that's the Nissan Altima. And it's basically a very boring car. There's nothing sexy or exciting about the Nissan Altima. It's a well-known segment, mid-size sedan. It's a well-known technology, internal combustion engine, and there's really nothing out crazy about it. And so if Nissan were going to build a new factory to manufacture the Altima, it would be perfectly fine for them to use their corporate weighted average cost of capital, because basically most of what Nissan makes is really boring stuff like that. So it would be perfectly fine. Now, they've come out with something new called the Nissan Ariya. Are you guys familiar with this? It's electric. It's electric. And we're going to know a couple of things about this. First of all, we don't truly know what the market is for electric vehicles yet, for a couple of reasons. Number one, supply seems limited, and number two, the demand right now has been artificially inflated by government action. What action is the government taking to artificially inflate demand for electric vehicles?
Don't you get some kind of like subsidiary if you have an electric vehicle?
Yeah, $7,500, depending on the vehicle. But that's the government will give you that money. Now, here's what I think is insane about that. What kind of people are typically buying electric cars? Poor people or rich people? Rich people. And we're going to take tax money paid in by poor people and give it to rich people so they can drive fancy electric cars. Does that sound right? There's something wrong here. Anyway, on with the story. We don't know what the true demand is, and we won't until those government subsidies disappear. And so there's some risk. There's more risk going on here than we would have if we were just trying to build the Nissan Altima. And so how would we find the discount rate for the Aria? Well, the first thing we would do is try to find an all-electric car company. And I would have used Tesla as this example, but what is Tesla into now other than electric cars? Okay, so that's actually not Tesla, that's the boring company, right? Or you're thinking, you're conflating Elon Musk and Tesla. What else?
Trucks.
Okay, so they're very good, they're getting into electric trucks. What else? Oh my goodness, you guys haven't been, do you not care about the planet? Have you not been keeping up with Elon Musk? Okay, so they're doing these batteries that are used to store energy on the grid. So that's one thing that is not electric car. And then they're also they bought Solar City. And so they're also installing solar panels, which are not electric cars. And so no longer could we say that Tesla would be a pure play. Now there is this company now called Rivian. Rivian is still an electric pure play company, and then there's Lordstown Motors, and then I think those are the two main ones that you could look at that are pure play electric car companies. And you could look at their weighted average cost of capital to figure out what is the discount rate for your project, because their operation is exactly as risky as this thing that you're about to undertake with your project. Now, how easy do you think it is to go out there and find pure play companies doing exactly what it is that you want for your project and nothing else? It's almost impossible. It's almost impossible. In fact, it is impossible if you're trying something entirely new. For instance, lately we've seen a lot about AI, artificial intelligence. If you were the first person to think about investing in building up one of these ChatGPT-like things, is there a pure play company out there that you can look at? No. And so a lot of times companies do this bump up or bump down for riskier or safer projects. In other words, let's say that our overall cost of capital is 9%, that's our weighted average cost of capital. They might say, well, there's a bump up of 3% for riskier projects and a bump down of 3% for safer projects. And so now we've got basically three categories. We've got ones that are safer, ones that are average, and ones that are riskier. Now, what do you think this leads to from a human behavior perspective? When the managers get in the room and they're all making the argument for their project to be accepted, what's more likely to make their project be accepted? A lower discount rate or a higher discount rate? So let's talk about how we're going to accept this. We're going to look, remember, the price or value of anything is the present value of the future cash flows discounted at a rate appropriate to the risk. The greater the present value of those future cash flows, the more likely the project is to be accepted. So we want this thing to be greater. What does that mean about R? What do we look for R?
Down.
Yeah. And so what this leads to is a lot of lying. It leads to a lot of lying. We would get in the office, out of the conference room, and this guy named Jason, I remember him. He was a terrible liar. He would always say, oh yeah, my projects are so safe, oh yeah. And I'm in there stupidly telling the truth about the riskiness of my projects. And so who was more likely to get their projects accepted? He was, right? He was the liar. And so if you get into a situation at a firm where you've got one of these situations and you are responsible for making the final decision, always take into account that these people are most likely lying to you, because people are scumbags. Very good. Questions so far? Okay, now that we know this, that the rate needs to go with the risk of the project, we can look at the security market line here. And down on the horizontal axis, we have the beta of the project. And we can use the security market line to come up with that blue line, which should be the dividing line between accepting and rejecting projects. But you'll see that a lot of firms, instead of doing something like the blue line, they just use a single cost of capital for the overall firm. And that has some bad impacts. First of all, look over here on the left. We've got a project that is above the security market line, therefore it is returning more than is required. It's definitely a positive net present value project using the correct discount rate. But if we're using that single weighted average cost of capital, the black line, we would reject that project. Let me say that again. We would reject that safer, profitable project simply because we're using the wrong discount rate, because that thing falls below the weighted average cost of capital. Now, what about a project over here on the right-hand side? This is a riskier project. It returns more than the weighted average cost of capital. Under the system of only using one discount rate, what would we do with that project? Would we accept it or reject it? Yeah, we're going to accept it, but should it be accepted? No, because it's below the blue line, which is the actual required return given the risk of the project. And so what happens is that we end up rejecting safe, profitable projects, and we end up accepting risky, value-destroying projects. Now let's talk about what that does to the assets of the firm over time. And by the way, this is an excellent multiple choice question. What does this policy of a single weighted average cost of capital do over time? Well, it makes your assets riskier. Why? Because you are rejecting low-risk projects and accepting high-risk projects. You're rejecting low-risk projects, you're accepting high-risk projects. And you know what? There's nothing wrong with your assets becoming riskier over time. But we discussed that risk and something else have to go together. What is it? Return. The problem is that the return doesn't go up commensurately here. The return actually gets lower as a result. And so this is why it's a bad deal. The risk of the assets of the firm get riskier over time, but they don't get the return that is necessary to compensate for that risk. And you say, wow, this is a pretty easy idea. Now I understand why we shouldn't use a single weighted average cost of capital. Undoubtedly, big companies are not dumb enough to be doing this. You would be wrong. First example, 1994, I'm working for Halliburton, which is a Fortune 500 company. And I am getting ready to do an analysis. And I asked for some guidance on the discount rate. And my manager, a man named Dan, told me, no problem, 11.9%. I said, He says, it's our weighted average cost of capital. Every project at Halliburton has to be judged against that 11.9% cost of capital. That's a Fortune 500 company. Now, you might say, well, wait a minute, that's the oil field. It's a bunch of people who grew up handling pipes and sacks of cement. Maybe they don't know what they're doing. Skipping forward in time, I'm talking to the VP of the customer experience at Walmart. He's one of our alums, great guy. And he gets introduced to me and he tells me what he does. And I said, well, what I have to do will have very little to do with what you do. He says, on the contrary. He says, every project that we come up with gets sent to the finance people, and then they look at it versus the hurdle rate. I said, the hurdle rate, what's that? He said, oh, it's the firm's weighted average cost of capital. Now, here's what I want you to know about Walmart. Used to be, in fact, we're sitting in a building named after a CEO of Walmart. I don't know if you knew that. It's not Glass Hall because it's got glass, right? It's David Glass, owner of the Kansas City Royals at one time or another. Back to the story. You might have, in their early days, forgiven them for not knowing something like this. But the truth is, after Sam Walton died, they went out and hired a bunch of Harvard MBAs, and especially in their finance area. Now, what does that tell us? It tells me that the education in finance is better at Missouri State University than it is at Harvard, because you guys would know better than to do that after hearing this talk, and those fancy Harvard MBAs apparently do not. Let's talk about the kind of projects that you might see with customer status or service or customer relationships at Walmart. Typically, roll back 10 years. If you bought stuff at Walmart and you got all your stuff in your cart, where do you go? If you're ready to leave, where do you go?
Checkout.
To the checkout. And the checkout is a cash register, and what's standing behind the checkout? A cashier, right? Okay, so that's the baseline. That's your run-of-the-mill average kind of thing. Then, what was the next evolution beyond the checkout? Self-checkout. Now, let's ask this question. Is self-checkout riskier than regular checkout? Yeah, why? Say it again. People can steal. It makes it easier for people to steal. When I used to be a cashier at a grocery store, and I'd say, "Oh hey, did we get that bag of dog food that's down beneath your cart?" And they're like, "Whoop, sorry," and we would get it. Now that's an innocent one. Do you think most of the activity of Walmart self-checkouts is innocent? There is not a whole lot that goes on. Well, never mind. I was going to make a comment about Walmart. It's kind of a scary place after dark. Okay, back to the story. Back to the story. So, so that required rate of return for putting one of those in would have to be higher than for a regular chip stamp. Okay, moving on. Now Walmart is working on this idea where everything in the store is going to have an RFID tag. What does RFID stand for? Anybody know? Do you guys know what they are? Ah, okay. So radio frequency identification, and it's a little tag, and you actually, the chip that's in your dog's neck is one of those, and all you have to do is hit it with some electromagnetic energy, and it returns a signature and tells you what it is. In the case of the dog, it tells you who's the owner. In the case of Walmart, it tells you what the item is, and the computer then links it up with a price. And the idea is if we put an RFID tag on every single thing in the cart, then we could just have the person push their cart through an RFID scanner, and it would go boop, 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 and add up all the things in the cart. That's step number one. Now, what do we always have to do when someone's buying something from us? We have to get money from them. If you've got a card with a chip in it, RFID can also interrogate that card and therefore pay for it. You know that where you tap your card? It's the same thing. Okay, now we have this where we can go boop, 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 push through. What's the risk there? Do you think it's possible that we might miss something? Do you think it's possible that scumbags might buy a roll of aluminum foil and set it up against the RFID tag on something really expensive? Apparently you guys are not scumbags enough to know how this would be done, right? You gotta have a knowledge of physics and scumbaggery, but it can be done. Okay, so that's the first problem. The second problem is, what if we don't manage to interrogate the credit card on the way out the door? Yeah, now that's gonna be a riskier setup. Should we require a higher discount rate for that project? Absolutely, we should. Okay, so once again, it's important not to use a single weighted average cost of capital for every project. there's only one place where that's acceptable. And that is, do you see where those two lines cross? Where the two lines cross is for a project that is exactly as risky as the firm overall. If the project is exactly as risky as the firm overall, perfectly fine to use the weighted average cost of capital, just like the Nissan Altima project. Questions? Okay, now let's talk about flotation costs. If we go back to chapter 5, we talked about bonds having what are called a sinking fund. And the sinking fund was used to purchase back those bonds. And we said that sinking a bond is the opposite of floating a bond. Now we're going to talk about the process of floating equity and debt. And we do flotations for both stock and bonds, and so they're both called flotations, and they both have costs associated with them. And let's explain why that is. If you go out to raise money externally, you're going to end up dealing with someone called an investment banker. If I say investment banker, let's talk about what kind of car you picture them driving. Are you guys familiar with the term investment banker? Ferrari, very good. Usually the first person throws out Mercedes, and I say only an unsuccessful one, right? In fact, the most Ferraris in New York City every year get sold when the bonuses get paid on Wall Street and the investment bankers go down and buy the Ferraris. Now, this leads us to believe that investment bankers make a boatload of money, and they do. Now, the question is, where does that money come from? And the answer is flotation costs. When an investment banker goes out and raises money for us, they don't do it out of the kindness of their hearts. They do it for a percentage. They do it for a percentage. And if I remember correctly, the percentage for equity is around 7.5%. Now, the flotation costs for debt are actually lower than that. And let's talk about why that is. Let's talk about the process by which you work with the investment banker. It's called underwriting. The investment banker is said to be underwriting the offer. And here's what they do. They actually buy these stocks or these bonds, and then they turn around and they sell them to retail distributors, or retail customers. So it would be pension funds, individual investors, mutual funds, that sort of stuff. Now, in the meantime, though, between the time they take control of these financial assets and the time they sell them, they have something called inventory risk. Inventory risk. Because they're actually buying and holding these things, they now have them as inventory. And so if the price goes up or down on those, it creates a risk. Of course, it would be great if the value of those things went up, but the big problem is when the value of these things go down. And so, which is more likely for you to be able to get a good calculation of the true value? The debt. And here's why. Because we have a fixed set of payments. We may not exactly know what the required rate of return is, but at least we know what those future cash flows will be. What about equity? There are no fixed cash flows, and we don't know what the true discount rate should be because it hasn't been out there trading yet. And so it's harder to guess the true value of equity than it is to guess that of debt. And it's also more likely for it to fluctuate because people's estimation not only of the required return can change, but their estimation of what those future cash flows will be change. And so there's a lot more chance that you're going to get burned doing an equity offering for a client than getting burned doing a debt offering for a client. And so that is why we see a higher flotation cost for equity than for debt. Now, at this point, a lot of people are like, wait, if the flotation costs for debt are so much lower, why don't we just finance everything with debt? Isn't that a great idea? We'll just finance everything with debt. Here's the problem. In finance, we have good theoretical reason to believe that there is an optimum capital structure for every company. In other words, an optimal total debt ratio. So, for instance, electric utilities should be running around 50% debt. What if an electric utility went out and funded all of their future projects using debt? What would happen to their total debt ratio? It's going to go up. It's going to move them away from that optimal capital structure. So we don't want to do that. So we'll talk about how we're going to handle that here in a little bit. Now, the other thing that people need to understand about flotation costs is that they are a dollar and cents cost at time zero for the project. You will actually see some finance textbooks that say, oh, well, we're going to add this weighted average cost of capital percentage to our weighted average flotation cost percentage, and we're going to use that in the project. Folks, that's total crap. That is total crap. It doesn't make any sense whatsoever, and I am ashamed every time I see a finance textbook that says that, because it's totally wrong. This is a dollars and cents cost up front. Example, we go out and raise $100 million in equity. Our flotation costs are 7.5%. Immediately, I'm getting $92.5 million, that's 100 minus 7.5, for issuing $100 million worth of securities. That is an immediate time zero cost of $7.5 million, dollars and cents. So that's why we're always going to account for the weighted average cost of capital up front at the beginning of the project. It's kind of like when you buy a new house. Anybody here buy a house? Okay, when you bought the house, did you just pay the amount that was asked for the house, or was there some extra crap? Yeah, there's extra crap. And because you borrowed money, there was some sort of origination fee, right? That's just like flotation costs. So that origination fee that you paid, and I've had to do this one time. I sold a house 10 months after I bought it because we got ran out of Mississippi. It was a story for another day. So, by the way, that origination cost is the same for that house in Mississippi as it was for my house here. I've been in my house here for 16 years now. Do you think I should have added that percentage to my mortgage rate? No, that cost is gone. At time zero, poof, that money is just gone. Does that make sense? Okay. Okay, now I mentioned a minute ago that we want to maintain our current debt to equity ratio, or our current total debt ratio, our current capital structure. And so regardless of how we choose to finance this next project, we are always going to assume that we raise the capital for that project in the same proportions that we have in our current capital structure. The only way for me to maintain a 50% total debt ratio is to raise half the money in equity and half the money in debt. If I do it any other way, I'm going to end up floating away from that. So that's always going to be my assumption when I come up with the cost of raising the money. Now, in truth, I might go out and fund this project with debt and the next project with equity. And as long as it averaged out over time that we're staying around where we need to be, it would all be good. But if I let people make the argument, well, hey, we're going to finance the next one with debt, so we should use this lower weighted average flotation cost, we'll just use the debt portion. Here's the problem. Number one, that makes the current project more attractive than it actually is. Number two, what does that do to the next project that we go out and say, well, we're going to have to issue debt for that one? It disadvantages the project after. It disadvantages any project that we think we might finance with equity, and it unfairly advantages any project that we think we might finance with debt.
So for the financial purpose, do companies look at projects as each their own individual thing, or do they want like the weighted averages of like the risk?
Oh, very good. Okay, so the rule of thumb is this. Actually, it's not a rule of thumb, it's a mathematical law. We accept all positive net present value projects. And those are the projects where the present value of the future cash flows exceeds that initial investment. And so companies, and that's the theoretical thing, would be to accept all of those projects. Does that make sense? Now we're going to talk about some things in chapter 7 about what to do when we don't have enough money to accept. And then we'll get into some of what you're talking about. Good question. Other questions? Okay. So, how are we going to do this? Well, we are going to use what's called the weighted average flotation cost. Not to be confused with the weighted average cost of capital. This is the weighted average flotation cost. It's the percentage of whatever money we raise that we're going to have to give to the investment banker. The weighted average flotation cost is the percentage that we're going to have to give to the investment banker. And we're going to call it S of 0 here. And we're going to use some weights that you're probably familiar with. You see the E over D plus E and the D over D plus E? That first one is the proportion of the capital structure that is equity. The second one is the proportion of the capital structure that is debt. What do those always have to add to be? Now, they've got to add to be 1. And then we're going to multiply by F sub S and F sub B. F sub S is the flotation cost for stocks. F sub B is the flotation cost for bonds. Which one of those is always going to be higher? Yeah, the flotation cost for stocks will always be higher than the flotation cost for bonds because of that inventory risk. Now, something to notice here. You might be tempted to throw a 1 minus T sub C after that flotation cost of bonds, F sub B. But you shouldn't, and here's why. Because for tax purposes, these things are treated identically. These are treated identically for tax purposes. There is no tax advantage to raising debt flotation cost-wise than there is to raising equity. And so we don't see the 1 minus T sub C here. Any questions so far? Okay. Now, final note. If we are using internal equity, by the way, where does internal equity come from? Yeah, very good. Retained earnings. So if the company makes money, net income, and doesn't pay it out as dividend, the money that is left is added to our accumulated retained earnings. And we know that accumulated retained earnings falls under equity on the balance sheet. And so that's internal equity. You guys can think back to chapter 3 on that. So that's internal equity. Now, what is the cost for raising internal equity? 0. We don't have to engage an investment banker to do that. And so that means that we can actually set F sub S to 0 if we're using internal equity. We can set F sub S to 0 if we're using internal equity. We can set F sub S to 0 if we're using internal equity. So here is our weighted average flotation cost example. Your company is financed half with debt, which has a flotation cost of 5%, and half with equity, which has a flotation cost of 15%. These numbers are purely made up, by the way, because we know that stock is around 7.5%. What is your weighted average flotation cost? Well, I just said half debt and half equity. What are the weights? 1/2 and 1/2, right? And so they're equally weighted in this case. And so what I'm going to do is I'm going to take half times that 15%, which is for equity, and half times the 5%, which is for debt, and I'm going to add those together. So that first part is 7.5%, the second part is 2.5%. I add them together, I get 10%. What does that mean? It means if I go out and raise $100 million, how much money am I actually going to get? I'm only going to get 90, right? I'm only going to get 90. And so if I actually need 100 million, I'm going to have to raise more than 100 million. So I have enough to undertake the $100 million project and pay off the investment bank. Does that make sense? Okay, so what does that mean? We've got to raise more than 100 million. How much? Well, we can do some accounting here, some calculations. the amount needed, that's the amount to go out and buy the factory, is equal to the amount raised multiplied by 1 minus that weighted average flotation cost. In our case, it is 10%, and so basically the amount needed is going to be equal to the amount raised times 0.9. We're trying to figure out how much we need to raise, so I'm going to use algebra to rearrange that equation and say that the amount to be raised is equal to the amount needed for the project, divided by 1 minus the weighted average flotation cost as a decimal, not a percentage. And so when I do that, I see it's 100 million divided by 1 minus 0.10. That's going to leave me with 111.11 million that I've got to go out and raise in order to be able to get 100 million in capital that I can actually spend on the project. Now, we would say that the flotation cost for this project is 11 million, 0.1111 goes on forever. Why is the flotation cost 11 million and change? Because we had to go out and raise 111 million and change to get 100 million. The difference between those two is our dollars and cents flotation cost. And for my time zero cash flow, instead of a negative $100 million for the investment, it's going to be negative 111.111111. It's going to be the cost of the project plus the flotation cost. Now you say, well, might not make a difference, who cares? Well, let's think about this. What if I had a project that had an NPV of positive $5 million? We just said that the rule is we accept all positive NPV projects. NPV, positive $5 million, do we accept or reject? Yeah, we accept it. Now, after we add in our flotation cost of 11.111 million, what is the net present value of the project? Yeah, it's negative 6.11111. Does that make sense? Do we accept it or reject it? Yeah, we reject it. And so it can change the decision on a project. It can change the decision on a project. Therefore, you must always include the flotation cost as a time zero expense on your project. Now, what if you're working a project, what if you're working a problem and I haven't given you any information about the flotation cost? Do you have to do anything? No. But if I give you weighted average flotation cost and ask you to figure out the NPV of something, you better include the flotation cost at time zero. Questions? Yeah?
So will you always give us like FB and FIs, or will we have to like someone calculate that?
No, there's no way that I could give you something to calculate that. I mean, I could come up with something, but it would be cruel and I wouldn't do that. I mean, I may be cruel, but I'm not that cruel. Good question. Other questions? What would I have to do? I would probably give you some recent examples of IPOs and how much that it brought in versus how much they had to issue, and you have to figure it out. You don't want that. Okay.
I just got it wrong.
What's that?
I just got it wrong.
You just get it wrong. That's why I'm not going to do that to you. Yeah, not to say that I won't trust out that you will get wrong, but okay. Questions? It's never my intention to throw out a question that everyone will miss. Know that. It's never my intention to throw out a question that everyone will miss. That's a bad question. Okay, so that is the end of chapter 12. Now, we're actually running a little bit ahead, so I want to go ahead and talk about, get started in chapter 7. Yeah, go ahead.
Do we need to know the revised or proposed? This is from the.
Oh, yeah. So, no, don't worry about the tax update. Don't worry about the tax update.
For all chapters, don't print.
Yeah, don't worry about the tax update. And here's why. That was done in 2017, and it has a sunset date on it. And I think the sunset date's already passed on some of that stuff. And so basically, by the time you guys get around to applying that, that whole law will probably be off the books. Okay, so let's talk about investment decision rules. We said earlier that the goal of financial management is to maximize shareholder wealth. And what we want to do is choose projects that maximize shareholder wealth, stay away from projects that destroy shareholder wealth. This is why finance is so much, to me, more exciting than accounting, because we're making decisions about what to do in the future instead of just recording what happened in the past. So we need rules to figure out which of these things that we want to accept and what we should get away from. But we're going to see that some of these rules are better than others. And in fact, there's one that stands above them all, but there may still be need for these other rules as we go along. Some of these rules, we'll learn their advantages and disadvantages as we go along. And by the way, those advantages and disadvantages are great material for multiple choice exam questions. The advantages and disadvantages of these are great material for multiple choice exam questions. So let's talk about what makes a good investment rule. First of all, it has to account for the time value of money. Is the time value of money real? Let me ask you on a very simple level. Would you rather have $1 today or $1 a year from now? Today. Let me ask you again, is the time value of money real? Absolutely it is. And so whatever we come up with needs to account for the time value of money. It also needs to account for the riskiness of the cash flows. Which would you be more willing to invest in? Something with lower risk or higher risk? Lower risk, right? So we know we've got to have, and we know that the return has to go with that riskiness. And so we also need to look at that. And then it needs to provide information regarding the wealth created by the project. And here's why. What's the goal of financial management? Maximize shareholder wealth. If we don't know how much value a project is creating for the shareholders, how can we know whether it is helping or hurting us in our pursuit of that goal? Let's talk about the gold standard. The gold standard is net present value. You've already heard me mention it today. And the book actually describes it as the present value of all the cash flows subsequent to the initial investment minus the initial investment. What does subsequent to mean?
Following.
Yeah, following or after, right? And so basically, implicitly, what that means is that they're assuming all the investment happens at time 0. How long do you think it takes to build a car factory? Yeah, it's like 3 years. Time 0, time 1, time 2, time 3 will all have negative cash flows. And then we start to see positive cash flows. And so I prefer my definition of this, and that is that it's the sum of all present value of the project cash flows, where cash flows in are positive and cash flows out are negative. And so that's, Ms. Roll, you're wrinkling your nose. So let's think this through. If I'm going to go out and build a factory, is that a cash flow in or out? Out.
Thank you.
What would the sign be on that? Negative. But then we start making cars, and as we sell those cars, the money starts to come in it. What would the sign be on that? Positive. Now, does that help you with your nose wrinkle?
Yes, thank
Very
you.
good. Okay. I know she was wrinkling her nose outwardly. Many of you were doing it inwardly, right? Okay. Now, the idea is that we're going to add all those present values together, and we are going to accept all projects with an NPV greater than 0, because after all, they increase shareholder wealth, and we are going to reject all projects with NPV equal to or less than 0. Now let's think about this. Students sometimes, they're like, yeah, I understand why we're going to accept the ones that are positive, but why would we not also accept the ones that are 0? I'm going to give you 2 reasons. Number 1, implementing a project is hard work, and I'm lazy. If I told you today that you're going to go through all this MBA thing, and there isn't going to be any benefit for you on the backside, would you come back to class on Thursday? No. Today's Thursday, isn't it? Would you come back to class on Tuesday?
No.
No. And so if there's not going to be any benefit from doing something, I shouldn't do it. And here's reason number 2. Do you think you truly know these numbers with certainty? No. In fact, everything involved here is a swag. Everything involved here is a swag. For sure, the future cash flows are a swag. Do we know the future cash flows with certainty? No. If you do, come to my office, we'll get rich together, right? We don't. Now, the discount rate. Do you remember when I showed you those linear regressions and it looked like a shotgun blast and we were coming up with a line for beta? Do we know the required discount rate with certainty? No, it's a swag. You say, well, at least we know the initial cost with certainty. So I'm going to install a machine. I have a quote for the machine. I have a quote for the installation of the machine. What could possibly happen that would make that to where it was a number that we didn't truly know? Let me tell you my own experience. I had a new machine coming in, and altogether, the installation plus the machine were supposed to be $700,000. $700,000. The NPV for the project was $25,000. Should I accept the project or not? Positive $25,000. Any homework or exam? The answer is yes. Now let me tell you what happened. We did our homework. The project was supposed to have 12 inches of solid concrete to anchor the machine into. By the way, if you're doing precision machining, you've got to anchor the machine down or your parts will not fall within the correct tolerances. The machines don't work that way, they're very precise. And so we had rolled out the plans from 1962 when the plant was built. And we saw the area where we planned to put this machine had on the plans 14-inch thick concrete. The machine only needs 12. Am I good to go? Yeah. And so the day comes, the machine's there, we're ready to go, and the millwright's the person that installs the machine, the millwright comes in, and the first thing that he does is to drill the anchor holes for these 4 anchor holes in 12 inches into the concrete, right? And so here's what it looked like. Then drilling it down, it took a lot of effort for about 4 inches, and then what happened? How thick was my concrete? 4 inches, not 14. Now, why do you think my concrete was only 4 inches thick and not 14? Roll back to 1962. What do you think happened?
Just pen and paper, they just probably put 4 instead of the 1.
Oh, no, this wasn't an error. This was pure scumbaggery.
No codes in place to.
Yeah, there was no inspection. And the contractor, what's cheaper, a 4-inch concrete floor or a 14-inch concrete floor? Yeah, 4 is cheaper, right? Because you're only 4. Yeah, right. And so what did the guy do? He skimped us, right? He totally gave us a shaft on 10 inches of concrete. And I tell students this story, and they're like, well, did you hunt that guy down? The year was 1997 when I was doing this. It was the plant was 35 years old. What am I gonna do? Go to the nursing home and kink this guy's oxygen hose? Right? Long since gone. The statute of limitations is up. Now here's what you need to know. I've got the machine there. I kind of need the machine because I've already got the old one out of the way and on the truck with the dealer. What have I got to do? I've got to make that concrete thick enough. And so what do I have to do? I have to get a contractor in with a concrete saw to saw out a rectangle that was bigger than the machine. And then I have to get some people in there, one of those little tiny backhoes, have to get that in there to dig out that hole. And then we have to put some reinforcing bar in there and reinforcing wire. And then we have to pour the concrete. And then we have to let it cure for at least 24 hours before we do anything with it. Now, when I started, my installation cost in a machine, $700,000. I'm having to spend an extra, oh, and by the way, this was back before the invention of that concrete pumper thing that you see people getting pools behind their house, the swing that goes over the house. We didn't have that, so what did we have to do? We had the concrete ready-mix truck out back, and it was filling wheelbarrows, and I had a bunch of guys that looked like a string of ants bringing in, it was a bucket brigade, dumping concrete into this hole, or cement. Okay, so now we're back and we're ready to go. I spent $40,000 getting that floor fixed. The project had an initial NPV of $25,000. What's the NPV now? Negative $15,000. Do you see how that works? And so that's what I'm telling you, you cannot know these numbers with absolute certainty, even the ones up front that most people think we can know. It just doesn't happen. And so as a result, on tests and things, when I ask you to do NPV exams or examples, you will always accept the positive ones. In the real world, you want to make some deeper thoughts before you make your decision. For example, if I'm going to go out and invest $5,000 on a project with a positive NPV of $1,500, does that sound reasonable? I think so. I'm going to invest $5,000 and get $6,500 back. I'm fine. Now, what about if I'm investing $1 billion and I've got a positive NPV of $1,500? No way. On an exam or on homework, you would say yes. In the real world, you'd say no way, man. Now, I'm going to tell you one more thing. On occasion, we must accept a negative NPV project. On occasion, we must accept a negative NPV project. And typically, it falls under regulatory compliance. Whether it's environmental stuff or safety stuff, you can't say, oh, I'm sorry, we're not going to comply with that law because it's a negative NPV project. Let me give you an example. I was a manufacturing engineering manager up at a plant in Ohio, and I get a call from the front desk. And they tell me there's someone there to see me. And I'm like, phew, could that be? So I go up there, and it's a little guy with a horseshoe of hair, and he's got his glasses on the end of his nose, and he says, are you Haggard? And I said, yes. He says, I'm with the Ohio Department of Natural Resources. I'm like, well, good for you. I said, what do you want with me? He says, I'm here to see your paint system. I said, okay. I said, you got your safety glasses and your steel toes? He said, yes. I said, let's go. So we take off back through the plant, and I take him up and I say, here it is. And he stands there, and I'm not kidding, this is what he does. You ever seen a wild animal sniffing the air? That's what this guy looked like. I said, what's the issue? He says, your paint process uses VOCs. Like Voice of Cambodia? And he says, volatile organic compounds. I said, oh, do you mean paint thinner? And he said, yes. I'm like, yeah, pretty much all the paint systems that I know of use paint thinner. He says, well, you can't have that. And I said, why not? And then he said something about it being bad for the ducks or something. I forget. It's bad for the ducks. Okay. Then I'm like, well, I say, obviously, you are a learned man in these things. What have your other clients, I'm being nice here, what have your other clients done to fix this problem? And he says, well, they'll use what's called a powder paint system. And powder paint is where you hang these metal parts on a conductive hook and you put a negative electrical charge on the part, And then you've got these little bitty tiny plastic pellets, and you put a positive charge on them and you spray them at the part. What happens when positive and negative come into contact? They attract, right? And so these little paint pellets will stick to the parts, and then you run them through an oven, and the oven melts the plastic and makes a nice paint-like film over the entire part. Problem solved. I'm like, wow, that is slick. So I go back to my office. The year is 1999. So we had the internet, barely. And I do a little research, and I figure out about powder paint. I'm like, yeah, this guy's pretty sharp. So I work up the NPV project on that powder paint. It was slightly negative NPV, yet we still accepted the project. Why? Yeah, we had to. What was the state of Ohio going to do to us? Yeah, no, they wouldn't have shut the whole factory down. They would have only shut our paint process down. But I'm here to tell you, nobody wants to buy a truck suspension with no paint. Any ideas why?
Rust.
Yeah, they rust, especially up north, right, where they got the salt on the roads. And so we had to do it in order to preserve our other cash flows. And so occasionally you have to accept a negative NPV project. However, what if the NPV were so big that it wouldn't be worth preserving those other cash flows? Then we just go out of business. So for example, when I worked at Halliburton in Oklahoma, we had this thing that no matter what we did, it was really going to be bad. So what we ended up doing is actually outsourcing that entire process to a company in China. By the way, the reason it was going to be a problem for us is when you cut this particular plastic, let's call it plastic, it creates a deadly, dangerous gas. You know how expensive it would be to get rid of the deadly, dangerous gas? Now, when we sent it to China, do you think that they actually put together a facility that could handle the deadly, dangerous gas? No, what did they do? Let's put in a vent fan, right? Expelled it to the atmosphere. So not only did we imported the part, but we exported the pollution. In that case, there was no way we could make it financially feasible to continue to do it. Questions?